So, the Federal Reserve just did something that has pretty much everyone scratching their heads. Their December 2025 meeting is going to go down as one of the most confusing and maybe one of the most important in a long, long time. What on earth just happened?
And that's the big mystery, right? On one hand, they cut interest rates. That's the classic move when you think the economy needs a little juice. But at the exact same time, they sent a huge signal that they're going to be super cautious going forward. So, what gives? Are they hitting the gas? Or are they hitting the brake? Let's figure it out.
Okay, so here's how we're going to break it all down. First, we'll look at the contradictory signal itself. Then, we'll dig into why they cut rates in the first place. And right after that, we'll explore why they're so worried. We'll see how this whole thing created a major split inside the Fed. And finally, we'll connect the dots and see what it all means for the economy and for us in 2026.
All right, let's dive right into this puzzle. You know, Fed Chair Jerome Powell himself called this a very unusual economy. And honestly, the Fed's decision reflects that perfectly. It's weird.
Yeah, the term everyone's throwing around is a hawkish cut. They gave the market an interest rate cut, which is dovish, but they wrapped it in all this tough, cautious language about the future, which is hawkish. And you can bet the markets were totally baffled. The US dollar dropped almost immediately as traders just scrambled to figure out which signal to follow.
So let's get this straight. You've got three things happening all at once. Step one, they cut rates. Okay, that's easy. Step two, they're going to start buying $40 billion a month in treasury bills. Sounds like easing. But then, step three, they release their own forecast, the dot plot, that says they only plan to cut rates one more time for the entire next year. So an easing move, a liquidity injection, and a super cautious forecast, all at the same time. No wonder everyone's confused.
Okay, so if they're so nervous about the future, why on earth did they cut rates at all? Well, to get that, you have to look beyond the numbers you see on the news. You have to look at what the Fed is really worried about. See, this rate cut wasn't about hitting the gas to stimulate growth. This was a purely defensive move. The Fed is seriously concerned that the job market is much, much weaker than it looks on the surface, and they decided to act before it becomes a full-blown crisis.
Now, if you just look at the headline number, everything looks great, right? 4.4% unemployment. By any historical measure, that's fantastic. You think the job market is rock solid. But this is where things get interesting.
But then, Chair Powell drops this absolute bombshell during the press conference. He basically admits that because of all the weirdness in the data and how it gets revised later, he thinks the economy isn't adding jobs at all. In fact, he thinks it might actually be losing 20,000 jobs a month. Just think about that for a second. They're making policy based on data they think is coming, not the data we have today. That's how worried they are.
And if you needed more proof, just look at this. This is the U6 unemployment rate. It's a way broader measure that includes people who are working part-time but want a full-time job or people who've just given up looking for work. And it's at 8.0%. That huge gap between the official rate and this one tells you there is a ton of hidden weakness in the job market, which is exactly what the Fed is seeing. Okay, the rate cut makes sense now. It's defensive. But what about this $40 billion a month in Treasury purchases? I mean, that sounds a heck of a lot like the stimulus programs we saw in the past, right? Well, not so fast. The Fed went way out of their way to call this Reserve Management Purchases, or RMP. And you should think of it like this. This isn't about flooding the whole economy with cash to boost growth. It's more like a plumbing operation for the banks. They're just making sure there's enough cash in the system so that the short-term lending markets don't freeze up.
And you really got to understand the difference here. RMP is a technical fix for the banking system's plumbing, using short-term bills. QE, quantitative easing, that's the big bazooka. That's broad economic stimulus, using long-term bonds to make things like mortgages and car loans cheaper for everybody. This new program is not meant to do that. Let me say it again, just so we're all clear. This is not QE.
Okay, so we've got the dovish part down, why they hit the gas a little. But that's only half the story, right? Now we have to figure out why they're also slamming on the brakes with their guidance for next year. It really boils down to three big worries. One, inflation is still just too sticky, and it's well above their 2% goal. Two, a lot of that inflation is coming from tariffs. That's a supply problem, and interest rates aren't a great tool for fixing supply problems. And three, they see some huge economic booster rockets getting ready to fire up in 2026.
And this really paints the picture of the tightrope they're walking. On one side, you have these huge growth drivers coming, Massive spending on AI infrastructure plus a big new fiscal stimulus and tax cut package. But pushing back against that, you've got this stubborn inflation from tariffs and a global economy that's slowing down. The Fed is stuck right in the middle of it.
So you've got these massive forces pulling the economy in opposite directions. How do you possibly make a single, unified decision? Well, spoiler alert, you don't. And that's why this contradictory policy actually makes a weird kind of sense.
The vote was 9-3 to cut rates. I mean, you almost never see a divide that deep on a rate decision. It just goes to show you how intense the debate was behind closed doors. This was not a happy consensus. This was a hard-fought compromise.
And you can basically break the committee down into three camps. You had the doves, who wanted to cut even more to protect against the downturn. You had the hawks, who didn't want to cut at all because they're still laser-focused on inflation. And then you have the centrists, led by Powell, who cooked up this compromise. They're all just prioritizing different parts of the Fed's dual mandate, jobs versus inflation. So, okay, the Fed's divided, their policy is this weird compromise. What does any of this actually mean for the real world, for our money? Let's talk about the outlook for 2026.
All right, here's the cheat sheet for what this could mean for different assets in 2026. The outlook seems pretty good for U.S. stocks, since they should get a big boost from all that AI spending and government stimulus. For long-term bonds, it's more of a mixed bag. A flood of new government debt coming could keep prices from really taking off. And for things like oil and metals, a weaker global economy is probably going to be a bigger deal than a small rate cut here in the U.S. So if you're going to remember one thing from all this, let it be this. The Fed has made a strategic choice. They've decided they're willing to tolerate some higher inflation for a little while, as long as it's the kind caused by tariffs. And they're doing that to buy some insurance for the job market, which they think is on thin ice. They're essentially making a bet, a big one, that all this new spending on AI and from the government will be enough to power the economy through this rough patch.
And that leaves us right here. The Fed is walking this incredibly thin tightrope. On one side is a deep recession, and on the other is the fire of runaway inflation. This hawkish cut is their attempt to stay balanced right in the middle. But the real question is, in a couple of years, will we look back and say this was the move that saved the day, or the one that let the inflation genie out of the bottle for good?